Welcome back, everybody. It's time for a general market update. It's April 5th, 2024. Welcome back, everybody. Just a reminder, I'm an amateur individual growth stock investor, but I've been doing this for a long time, over 20 years. So the agenda today is to get into the indices, get into breadth, which we've been watching very closely over the past month. Then we're going to turn our attention to sentiment, and then to what I call the young guns, which is really talking about new merchandise and IPOs. Excuse me. And then we'll wrap up. So as a reminder, though, the Boston Meetup is having their next free meeting on April 10th. Greg Morton, who is really very sharp with IPOs, will be joining us from the East Greenville Meetup. So just go to meetup.com and sign up there. We have a great number of people signed up. And if you sign up, there will be a recording which we can send out. And those of you that are still interested and want to be put on an early bird list for Rain King Insights, just send me an email at support@rainkinginsights.com. And at the meetup, I'm going to give a very brief overview of the new website. So let's get into the indices and breadth. So I'm starting with this diagram, really. This is the January 2022 chart of the NASDAQ. And what I'm trying to show here is I wanted to help define what I consider to be a pullback, an intermediate correction, a bull market correction, and a bear market and a major bear market. This is the way I look at it. So when we come off a high, a 3 to 5% is really coming down with a pullback. It's really a brief pullback within a bull uptrend, and there's really no need for a follow-through day in order to resume the trend. It's when we get 8 to 12% off the highs that I call that an intermediate correction, and that would require a follow-through day to really reset a next leg higher. Obviously, if you keep going lower, you get into the correction territory as well as major bear markets, which are off at least 25%. And you can see some of the definitions here. So I wanted to share that to put things in context as we look at the current market. So here we are, April 5th. This is the NASDAQ. And I've simply just drawn those shaded areas. A 3 to 5% pullback would put us in this zone here, which would be, we're almost down to the 50-day. This would go slightly below the 50-day, 3 to 5%. 8 to 12 would bring us all the way back down in here, which is really where the last little breakout occurred. Also would be approaching the 200-day moving average. If we break that, then there's something really wrong with the market, and maybe we're entering a bear market. Now, just to add a little bit of humor to this, Jim Ropel had an IBD podcast about a week ago. I think it was 4 days ago. It was released, and he was very, very bulled up. So I think he put the curse on us and has really started this correction. It's only been a couple days, and things have really had that nasty day yesterday. So I say that tongue in cheek. Jim's a great guy, really positive guy, but maybe he put the curse on us to get this correction started. Okay, so let's look at the NASDAQ 100. Just wanted to point out a couple of things here. We've been talking about the distribution. Over the past 2 months, we've had this terrible pattern of higher volume on the down days and weak volume on the up days. And this blue line is the relative strength against the S&P. And you can see that the relative strength, really the relative strength line peaked out at the very, very beginning of February and just keeps going lower and lower, even though the index is chopping its way higher. So the internals of the NASDAQ were not very strong. Now, we had that nasty day yesterday with a higher volume distribution. And so far, it's about 3 o'clock Eastern time. This volume on the bounce, I can't say is very inspiring. It's a little bit of a surprise with the news on the jobs report, but I can't say that it's showing a lot of buying. Now, we know the NASDAQ 100 was led by the Mag 7. And in 2023, the Mag 7 were really the place to go. They were really overweight positions for many, many institutional managers. We're probably seeing rotation out of those trades, unwinding of those trades. So I would keep an eye on the small caps, the IWM and the MDY, which is the mid caps. They may be the indexes that actually will outperform on the next leg higher. That said, obviously NVIDIA and a couple of others are doing well. But we certainly see a lot of weakness in things like Apple and Tesla, dragging down the NASDAQ 100. So I put this chart up last week. This is the S&P, and the 2 points that I made on this chart was, number one, the controlling intermediate trend was the 20 EMA. And I also made the point that some of these new highs, which look fairly good on the surface on the bar chart here, were actually not so good because the indexes were reversing and closing at lows. And we talked about these potential air pockets where you get some corrective action and price action. So that's where we were last week. Now, here we are as of today. And I point out, looks like we're going to close below the 20-day. We haven't closed below the 20-day in a very long time. That's character change. So it looks like we're going to pull down. The question is how far? And I just put on the chart here, a 5% pullback in the S&P, which is really the leading index, would bring us right down to the 5,000 psychological level. That could be support. Also, I just wanted to point out one more time that even though there were net new highs yesterday, and it looks fairly good, a more discerning eye would really look at this and say, yeah, but there was new highs early in the session, and then they sold off really hard. So it was not a great day, similar to those other days we mentioned where there's stuff going on underneath the surface. So let's take a peek at sentiment. This is the American Association of Individual Investors as of Wednesday, when their latest survey was released. So you can see here that this shows you the past 4 weeks. And you can see here the green is representing bullishness. So we're at 47.3% bullish, a little lower than the 50% a week ago. But when you look at this compared to historical averages, the historical average for bulls is about 37.5. So amid a bunch of deteriorating market internals, we have high bullishness in the public. That's really a contrary factor. When the public is really bullish, things tend to go the other way. And you can also notice on the other side of the spectrum, very low number of individual investors that are bearish, only 22.2%. And you can see here the average is in the range of 31%. So this is really used as kind of a tertiary indicator of sentiment. And generally, it's a contrarian indicator because when you see high bears, as we show here, that was when the market was bottoming right near the follow-through day. So that's not a great picture. You know, the market's going to correct when everybody's bullish and fool the crowd. Now, this is the National Association of Active Investment Managers. This is a two-week moving average as of yesterday, April 4th. And this is what percentage individual active managers are invested in the market. So you can see here, and I've drawn these colors. Generally, when these national association surveys come out, when we only have managers 10 to 20% invested, they're very, very bearish and cautious. That's typically bottoms. And you can see here it got way down to about 10%, and that was the October 22 bottom. And then we also had a very low reading, almost to 20%, and that was right when we got the follow-through day. Now, on the upper side of the chart, when we get above 85% invested in these managers, it tends to be a hot market, and there needs to be some cooling off. You can see they got to 100 in July, and that's when we had that 3-month correction. Then we had them pretty high again, up around 100% invested, and we had the January sell-off to start 2024. Now, in March, we've had, again, some high readings actually above 100%, indicating there's some margin going on with active investment managers. And you can see that's starting to back off dramatically now. Things were kind of hot. A lot of people were on one side of the boat. So again, it's just something to keep in mind that, you know, things are going to come down a little bit here, it appears. So this is two charts. I've shown in orange the equity put call ratio daily, and on the bottom is the VIX. This is the volatility index in purple, both on a daily time frame. A couple things to point out. We know that when the equity put to call ratio gets above 1, where I've started the shaded area. That means there's a lot of fear in the market and there's a lot of put buying. And you can see here that towards the end of March, there was some fear building in the market as we saw these spikes over one. It came off pretty sharply though, and some complacency is coming to the market. As I mentioned, the individual investors are very complacent and bullish, and the indexes look pretty good if you're listening to the news. They're at new highs. You should see the headlines in the paper. We're at new highs. Things look good. When really underneath the surface, they were not so good. So again, this starts to give us a little bit of a contrarian approach to the market, another indicator that we might need a little bit of a shakeup and a little bit of a pullback. Now, the volatility index on the bottom, we've had a very, very low volatility for months and months since this rally started. We had a little bit of spike above 16 recently, and you can see it's a pretty sharp volatility pickup. And you'll notice that we have not been at this level until you go all the way back into the end of the correction that we had in October. And I've marked, there's the follow-through day. So there's a lot of fear in the market back in September and October. And then we had the follow-through day and the rally started and the VIX really calmed down. And we had a nice, fairly smooth uptrend. But volatility is picking up. It's something to be aware of. A correction and sharp moves in the indexes on a daily basis tends to, freak people out a little bit. They get scared, and on sentiment can really start to unwind from being very bullish to much more of a fear-based mindset. So IPOs, I call these the young guns. Let's take a look at young guns. This is on the optimistic side that IPO market is improving. So new merchandise is always important to a bull market. So this is actually a chart showing the number of IPOs for years. It's looking at over 20 years. And you can see here that, back in 2021, there were over 1,000 IPOs. Now, typical in a bear market, very few stocks come public in a bear market. There's just no demand for new merchandise. And you can see 2022, 181, and 2023 was only 63, very low. That was the lowest reading since back into the great financial crisis in 08, 09. And you can see coming out of the bear market from the dot-com bust, 2001, 2002, low numbers of IPOs. So here's the encouraging sign. This is showing the proceeds from IPOs by quarter going back about almost 3 years now. And it's interesting because these numbers are in billions. And you can see during the bear market, all of 2022 and 2023, very low proceeds in the low number of this line represents the number of new issues in those quarters. The encouraging sign is in 2024, in the first quarter, there was $7.8 billion of proceeds from IPOs, and there were 30, which is starting to get to the higher end of this long 2-year bear market period. So there is some encouragement that more companies are coming to market. So this is a chart of the Renaissance ETF. Its symbol is IPO. This ETF is up 6.6% year to date as of April 2nd. And I just started to plot a basket of IPOs that have come public in the last 2.5, 3 years. And you can see there's a lot of names that were coming out, which is very typical. At the end of a bull market, you have lots of IPOs. Everybody's coming to market. And then all of a sudden, when we go into a bear market, the market for IPOs dries up dramatically. We started to see some activity throughout 2023 with some high-profile ones, such as Kava and ARM, and even Instacart. So I've just plotted them all. You'll notice that they're different colors, though. So what do the colors represent? All the names that are in black are IPOs that are generally, they're still in bases. So these are stocks to keep on your watch list. They're in bases, and you may have some good merchandise if we get another leg higher. All of the names that are shown in green are IPOs that are currently in uptrends. They are moving and they are in uptrends. And so you might look at those names during this correction for a pullback opportunity. And the ones in reds are breakdowns. These stocks have tried to break out, or they've reversed, or on the earnings reports have really, really broken down, and they're going to have a much longer base building process. So I just did this exercise to give you some excitement about there is new merchandise in the market, and build your watch list. Look at those stocks and bases, look at the ones in uptrends. It's going to be good opportunities if we get another bull leg higher. So 10-week pullback opportunities. So as position traders, pullbacks to the 10-week moving average are great opportunities for us to add to positions or even initiate a position. So I've just pulled up a couple here that are acting well. Sometimes if you miss a stock, this is an opportunity to get in. So here's Uber, which has been one of the leaders. And you can see here these are all weekly charts. Uber has had its second trip to the 10-week line, acting really well. You can see it's getting some good closes off that line. So that's a good one to keep an eye on or maybe consider. ARM Holdings, one of the hotter IPOs, had this vertical move, and it's slowly been digesting and calmly making its way back to the 50-day. This is the 10-week moving average here. This is the first trip, so there could be an opportunity there. And I also threw in CrowdStrike. I have disclosed I still have this position, even though it's been under distribution for the past probably 6-7 weeks. So I had a wild earnings day here, but the stock has calmed down a bit, and it's dangling around the 10-week moving average. Now, my 10-week sell rules, this has not triggered a sell of my position yet. So I'm following my rules and trying to hold this stock because I have a good cushion. So you should be looking at your stocks and how they act around the 10-week and whatever rules that you may have about buying or selling at the 10-week moving average. Now, the restaurant space has been very, very good lately, so I just wanted to put a few opportunities on the board. Here's Wingstop. We talked about this being a very persistent trend, and you can see here they had a pullback to the 10-week here. It just had its second pullback to the 10-week moving average. And generally, the first two trips of the 10-week moving average are very higher probabilities. When you get the third, fourth, fifth trip to the 10-week, they may work, but the odds start to go down. Chipotle, acting really well, had that big news of the big stock split. It's possible with the supply of stock from the split, the stock might pull in a little bit, could get back to the 10-week moving average. It might want to be on your watch list. It would be its second trip to the 10-week. And Shake Shack is our third one. You can see here, very, very powerful earnings gap, held this really, really well. And with the market pulling in, it's likely to touch the 10-week and provide possibly an opportunity to get in or to add to a position maybe that you bought lower in the chart. So there's some opportunities here that you got to keep your eye on if you're looking at weekly charts as a position trader. So let's get to the summary. So decline from the highs. Well, we had this really nasty reversal yesterday, kind of an expectation breaker. We thought we were going to go higher, things gapped up, and then they really sold off high volume, and it was really, really not a good end to the day. So we've had weeks of distribution, so I can't say that this is really surprising. I've mentioned these air pockets that I thought possibly could occur, and we look like we certainly had one on Thursday. But the distribution was giving us all the clues that this was possible. Now, what's interesting, though, is the character change, the break of the 20 on both the S&P and the NASDAQ, and it was a wide range outside day, very negative day. Today's day, so far, this is a little after 3 o'clock, is not exactly the most encouraging volume. Now, the power trend is still barely in place. The 20 EMA is still about approximately 1.5% above the 50-day. But if that 20 crosses below the 50-day and the 20 closes below the 50, that could turn the power trend off. So we'll keep an eye on that, but it's not looking great. New highs, new lows. We've talked about it. It's not really constructive on the NASDAQ. It's a little better in the S&P currently. Leading stocks, this strong job report has really erased this idea, I think, of June cuts from the Fed. The market had to adjust when at one time there was 60 to 70% odds that people thought there'd be March cuts by the Fed. So when that was a fallacy that Powell basically talked down. The market had to adjust, and we've pulled in. There's been distribution, and then this idea now that we were going to get June rate cuts. That mirage has also been kind of wiped away with the jobs report, and now people are saying maybe in September, maybe the end of the year, maybe there's going to be no cuts. So the market is going to have to adjust to that, and growth stocks will have to adjust to that the cuts are not imminent. So exposure levels, the action has not been good for a good 4 to 6 weeks. Last week I had people, I think, at 20 to 25% exposure. I continue to lower that. Despite what I see out on FinTwit and IBD, I think exposure levels should have been gradually lowered a lot in the last 3 weeks. Again, if you have a stock with cushion, it's okay to hold your best stock with good cushion. And I think you need at least 40% gain on that stock or more if you think you're going to hold through a pullback down to the 10-week moving average. And if you can stomach that, then try to sit with it. And that's kind of how I'm handling crowd. We'll see how it works out. But I definitely would not be initiating any new positions given the backdrop right now. Things are unsettled, and we probably need to pull in 3 to 5% pullback, which would be normal, but it's not a good environment to initiate new positions because you'll just get chopped up and stopped out. So with that said, that's really my summary of the week. Now, the quote of the week is an old hedge fund adage. It's, "He who fights and runs away lives to fight another day." And the last few weeks, if you've taken some pilot positions, and I have too, you've gotten chopped up. Things get stopped out, small losses, 1%, 2%, 3%. It can be frustrating. So, but the message is you can survive some frustration by cutting your losses short. You can't survive a devastating loss. So if you take pilots, cut those losses short. Otherwise, it's okay to sit primarily on the sidelines and let's wait for the fat pitch. That's the general market update for April 5th. Have a great weekend, and I'll see you all next week. And I'll actually see those of you that join us on the Boston Meetup on Wednesday night. See you soon.